Critical Mountain Pictures presents the Forex video trading series, Black Belt First Degree, Trading with Market Sentiment. In order to understand the futures market, first you need to know the people making the shots and those who are warming up the bench. These players could be categorized into three basic groups: commercial traders, the hedgers, non-commercial traders, large speculators, and retail traders, small speculators. The hedgers. Hedgers are commercial traders, or those who want to protect themselves against unexpected price movements. Agricultural producers or farmers who want to hedge, minimize their risk in changing commodity prices are part of this group. Banks or corporations who are looking to protect themselves against sudden price change in currencies or other assets are also considered commercial traders. A key characteristic of hedgers is that they are most bullish at market bottoms and most bearish at market tops. What does this hedgehog mean? I want your iPhone. Here is a real-life example to illustrate. There is a virus outbreak in the United States that turns people into zombies. Zombies run amok, doing malicious things like grabbing strangers' iPhone to download apps. It's total mayhem as people become disoriented and helpless without their beloved iPhones. This must be stopped now before the nation crumbles. Guns and bullets apparently don't work on zombies. The only way to exterminate them is by chopping their heads off. Apple sees a market need and decides to build a private samurai army to protect vulnerable iPhone users. It needs to import samurai swords from Japan. Steve Jobs contracts a Japanese samurai swordsmith who demands to be paid in Japanese yen when he finishes the swords after 3 months. Apple knows that if the dollar-yen falls, it'll end up paying more yen for the swords. In order to protect itself, or rather hedge against currency risk, the firm buys Japanese yen futures. If dollar-yen falls after 3 months, the firm's gains on the futures contract would offset the increased cost on its transaction with the Japanese swordsmith. On the other hand, if the dollar-yen rises after the 3 months, the firm's loss on futures contract would be offset by the decrease in cost of its payment for the samurai swords. Large speculators. In contrast to the hedgers who are not interested in making profits from trading activities, speculators are in it for the money and have no interest in owning the underlying asset. Many speculators are known as hardcore trend followers since they buy when the market is on an uptrend and sell when the market is on a downtrend. They keep adding to their position until the price movement reverses. Large speculators are also good players in the futures market since they hold huge accounts. As a result, their trading activities can cause the market to move dramatically. They usually follow moving averages and hold their position until the trend changes. The small speculators, on the other hand, own small retail accounts. These comprise of hedge funds and individual traders. They are known to be anti-trend and usually are on the wrong side of the market. Because of that, they are typically less successful than hedgers and commercial traders. However, when they do follow the trend, they tend to be highly concentrated at market tops or bottoms. The COT strategy. Since the COT comes out weekly, its usefulness as a market sentiment indicator would be more suitable for longer-term trades. The question you may be asking now is this: how the fuck do you turn all that big, giant, gobbled-up blob of text into a sentiment-based indicator that will help you grab some pips? One way is to use the COT report in your trading is to find extreme net long or net short positions. Finding these positions may signal a market reversal that's just around the corner, because if everyone is long on a currency, who's left to buy? No one. And if everyone is short on a currency, who is left to sell? What's that? Pretty quiet? Yeah, that's right. No one. One analogy to keep in mind is to imagine driving down a road hitting a dead end. What happens if you hit a dead end? You can't keep going since there's no more right ahead. The only thing to do is turn back. Let's take a look at this euro-dollar chart. On the top half, we've got price action of euro-dollar going on. At the same time, on the bottom half, we've got data from the long and short positions of the euro's futures divided into three categories. Commercial traders, blue line. Large non-commercial, green line. And small non-commercial, red line. Ignore the commercial positions or blue line for now, since those are only mainly for hedging, while small retail traders aren't relevant. Let's take a look at what happened midway through 2008. As you can see, euro-dollar made a steady decline from July to September. As the value of the net short positions of non-commercial traders, the green line, dropped, so did the euro-dollar. In the middle of September, net short positions hit an extreme of 45,650. Soon after, investors started to buy back euro futures. Meanwhile, euro-dollar rose sharply from about 1.2400 to a high near 1.4700. Over the next year, the value of the euro futures position gradually turned positive. As expected, euro-dollar eventually followed suit, even hitting a new high around 1.5100. In early October 2009, euro futures net long positions hit an extreme of 51,000 before reversing. Shortly after, euro-dollar began to decline as well. Holy fucking guacamole. Just by using the COT as an indicator, you could have caught two crazy moves from October 2008 to January 2009, and from November 2009 to March 2010. The first was in mid-September 2009. If you had seen that speculative trader short positions were extreme levels, you could have bought euro-dollar around 1.2300. This would have resulted in almost a 2,000 pip gain in just a matter of months. Now, if you had seen the net long positions were extreme in November 2009, you would have sold euro-dollar, and you could have grabbed about 1,500 pips. With those two moves, just using the COT report as a market sentiment reversal indicator, you could have grabbed 3,500 pips. Pretty out-fucking-standing, huh? Your very own COT indicator. Using the COT report can be quite a successful tool in spotting potential reversals in the market. There's only one problem, though. We simply cannot look at absolute figures printed on the COT report and say, it looks like the market has hit an extreme. Determining extremes can be difficult because the long and short positions are not all relevant. What may have been an extreme level 5 years ago may no longer be an extreme level this year. How do you deal with this problem? What you want to do is create an index that will help you gauge whether the markets are at extreme levels. Step-by-step process on how to create this index. Decide how long a period we want to cover. The more values we input into this index, the less sentiment extreme levels we will receive, but the more reliable it will be. Having less input values will result in more signals, although it might lead to more false positives. Calculate the difference in positions of large speculators and commercial traders for each week. The formula for calculating this difference is net position of large speculators minus net position of commercials. Take note that if large speculators are extremely long, this would imply that commercial traders are extremely short. This would result in a positive figure. On the other hand, if large speculators are extremely short, this would mean that commercial traders are extremely long, and this would result in a negative figure. Rank these results in ascending order from most negative to most positive. Assign a value of 100 to the largest and 0 to the smallest figure. And now we have a COT indicator. This is very similar to the RSI and stochastic indicators that we've discussed in earlier lessons. Once we've assigned values to each of the calculated differences, we should be alerted when new data inputted in the index shows an extreme 100 or 0. This would indicate the difference between positions of the true groups is largest and that a reversal may be imminent. I will say this again. An extreme of 0 or 100 would indicate that a difference between the positions of the two groups is largest and a reversal may be imminent. Remember, we are interested in knowing whether the trend is going to continue or if it's going to end. If the COT report reveals that the markets are at extreme levels, it would help pinpoint those tops and bottoms we all love so much. We dug around the forums and found this little gold nugget for you. Now that we know how to determine the sentiment extremes, what's next? Recall that not every sentiment extreme results in a market top or bottom, so we'll need a more accurate indicator. Calculating the percentage of speculative positions that are long or short would be a better gauge to see the market as topping or bottoming out. The equation to calculate the percentage long and percentage short is indicated. To To illustrate better, go back a few years and see what happened with the Canadian dollar futures. Going through the COT reports released on week ending August 22, 2008, speculators were net short 28,000 contracts. On March 20, 2009, they were net short 23,000 contracts. From this information alone, you probably say there's a higher probability of a market bottom in August since there were more speculators that were short on this period. But hold on a minute there. You didn't think it'd be that easy, right? Short and long ratios can help you spot market tops and bottoms. A closer look would show that 66,000 contracts were short, while 38,000 contracts were long. Of all the speculative positions in April, 63.3 were short positions. On the other hand, there were just 5,200 long contracts and 25,800 short contracts in March. This means that there was 83.3% of the speculative positions were short positions during that time period. What does this mean? There is a higher chance that the bottom will occur when 83.3% of all speculative positions were short, as opposed to just 63%. As you can see, the bottom did in fact not occur around August 2008, and the Canadian dollar was worth roughly 94 US cents. The Canadian dollar continued to fall over the next few months. By the time March came around and the percentage short hit 83%, the Canadian dollar hit a bottom around 77 US cents. Then what happened? It started to steadily rise. A market bottom? Yep, you got it. So those 1,000 moves excite you? Before we start betting the farm based on our analysis of the COT report, remember that those were just specific cases and when the COT report signals a perfect market reversal. The best thing to do would be to backtest and look at the reasons why a reversal took place. Was the economy booming? Was it in the middle of a recession? And remember, a COT report measures the sentiment of trader during a specific period of time. Like every other tool in your toolbox, using the COT report as an indicator does not always correlate to market reversals. So, take the time to study this report and get your own feel of what works and what doesn't. Also, to bring this lesson to an end, always keep in mind that market prices aren't driven by solely COT reports, stochastics, Fibonacci levels, etc. The markets are driven by millions of people reacting to economic analysis, fundamental reports, politics, Godzilla attacks, U.S. sighting, Lady Gaga concerts, life in general. It is how you use these tools that help you prepared with what lies ahead. In conclusion, as traders, it is our job to gauge what the market is feeling. One way to gauge market sentiment extremes is through the Commitment of Traders report. By understanding the market activities of the three groups of traders, commercial traders, non-commercial, retail traders, we can find ourselves in better positions to fish for tops and bottoms. Remember, every market top or bottom is accompanied by a sentiment extreme, but not every sentiment extreme results in a market top or bottom.